In this video, I use research from Forbes, other credible journals, and U.S. Secretary of State to confirm, is your money safe in banks? After the Silicon Valley Bank collapse, we're now seeing other banks have major drops in share prices. First Republic shares went from over $100 down to $13, and Charles Schwab went from $76 down to $53. The key to your money safety lies in the fact that the government bailed out SVB, but it didn't bail out the investors and the shareholders. They still lost money. It bailed out the account holders, the people. Not a single account holder lost money. So is your money safe in banks? Yes, partially, if your bank is insured by the FDIC and you have less than $250,000 in it. If the bank fails, you get your money back. Now, let's just say you have multiple accounts. That $250,000 is encompassing all of those accounts. So if you have some money in one account, account 2 has money, account 3 has money, it's not to say that each of those single accounts is going to be insured over $250,000. No, all of those accounts combined will be insured up to $250,000. Nearly all banks are FDIC insured, but if you're not sure about it, you can look at the teller window and look for the FDIC logo on the window or at the entrance of your bank. That's for the people who have less than $250,000 in their bank, but what if you have or will have in the future more than $250,000? If the bank fails, what's going to happen to your money? Will you get bailed out if the bank fails? Well, we must first understand that SVB is a large bank and most of its account holders are venture capitalists, basically big investors in the tech industry who are well off. The account holders of this large bank were bailed out, but the account holders of small banks may not be bailed out if the small bank were to collapse. In fact, small bank account holders were concerned about this because the U.S. Secretary of State said that anything over $250,000 at a small bank may not be guaranteed as insured unless the bank failure seemed likely to cause a widespread issue. If you're new to my channel, welcome. My name is Sky and I share knowledge to help you improve your financial well-being. Now, okay, if you have more than $250,000 in one bank, experts recommend that you split that money up throughout multiple banks. Now, if you don't want to move your money to multiple banks, right, even experts say that even people with uninsured deposits get nearly all of their money back. It takes time, but generally all depositors end up getting their money back. And this is from a consultant and a former attorney at the FDIC. The consultant and the former attorney did say that you may lose 10 to 15% of your money that is not insured, but it's never zero. I don't know about you, but I don't want to lose any of my money. So we're going to go for the insured and split it up in different banks when we're there at the 250K mark or when we get there in the future. Okay, you get the money back, but how long does it take? Well, historically, the FDIC has returned insured deposits to account holders within a few days of the bank closing. What will happen is they will either issue you a check or they will deposit the money into another account within another financial institution for you to access. And some of you may be saying, well, what exactly is covered? Because we got a checking account, we got savings accounts, we have mutual funds, and just different types of accounts. So what's covered? FDIC deposit insurance covers your checking account, your savings account, CDs, money order, money market accounts, and other official items issued by an insured bank. What FDIC insurance does not cover is stocks, bonds, mutual funds, life insurance, crypto assets. It doesn't matter if your money is in a bank or if it's in a credit union. Credit unions are also covered. The banks are covered by the FDIC and credit unions are covered by the NCUA. If your money is in a bank, if it's in a credit union, your money is safe. Your money, not your investments, your cash money. So with all of that, what is my personal opinion on the banking system? I believe that merely because our U.S. banking system was able to bail out all of those account holders and not a single person lost a dime of money, that's a testament to how strong our systems are. And if you look over the years, there's nothing that we can do to stop contagion where when one person does something, everybody else starts rushing and to do the same thing. You could be at your job, in the hallway, waiting for the elevator. If a few people start running out of nowhere, you're running. Contagion, it's human nature. In fact, this whole contagion thing happened in one of our most classic movies, A Wonderful Life. George was on his way to his honeymoon, and his friend was like, "Don't look now, George, but something funny is going on at the bank." Next thing you know, people are running to the bank to take their money out. They get to the bank, George is there, and they're asking for their money back. And he's like, "You don't understand. Your money is not in the bank. You guys are acting as if your money is actually in a safe in the bank. It's not here. It's in between this investment and that investment, and it's at this person's house and that person's house. The money is not physically here in the bank," is what he was telling them. That's just like banks in our world. The money isn't physically there. Too many people try to take it out, there's no money left, and that's what happened to George. Now in this movie, there was an antagonist, Mr. Potter, who was actually responsible for everybody running to the bank to go and take their money out, but George didn't know it until it was too late. Anyway, once word got out and a few people start taking their money out and more, and everyone wanted to take their money out until there was no money left for George. This left George down on my luck. This left George down in the dumps, and eventually the movie does progress to why it's called A Wonderful Life. But why did I bring this up? Well, because it's a perfect example of contagion. It's contagion that actually happened at a bank at that. Contagion is just that. It can't be controlled, but what we can control is how we handle it. What we can also control is the amount that the Fed insures. I believe that the amount should be raised higher from $250K, especially since $100,000 in the early 2000s is only $53,000 today. And you're probably like, "Listen, Sky, most people don't have more than $250,000 in their bank. But most people have jobs. And most people rely on their paycheck. When SVB collapsed, the company Etsy froze their payouts. So imagine not getting paid when you expect. Amazon was impacted, Roku, and 800 plus other companies. No, the average person doesn't have more than $250,000 in their bank, but businesses that pay people do. And if their money is impacted, then our paychecks are impacted. So I say, raise it up. Now, overall, from what I shared and from what the Secretary of State announced, it's good to know that our money is safe in banks. But if you want to ensure that you continue growing your money and avoid obstacles that may be holding you back from wealth, check out this video right here. For more videos like this, go ahead and subscribe to my channel. And with that, thank you for watching, and I will see you in another video.